Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Institutions ammo depleting? Next steps, storm or calm? TSLA, IGV, AVGO.
This video presents a direct informational narration of the source document. The source document begins by detailing market breadth and macroeconomic data. Looking at the S&P 500, we saw 334 components advance against 167 declines, which lifted the equal weight index by 0.63%.
Daily sector performance inverted entirely from the previous day. Today, 9 out of 11 sectors rose, with only 2 falling, whereas yesterday only 2 sectors were rising. Notably, semiconductors diverged from software to become the worst-performing subsector. On the macroeconomic front, the U.S. will allow up to 300,000 tons of beef imports over a 90-day period. We also have mixed August PMI data. Manufacturing unexpectedly dropped to 53.2, which is below the 53.9 estimate, but services jumped up to 56.8, bringing the overall composite PMI to 56. Moving to institutional positioning, the source document analyzes the recent slow market volatility by examining global fund cash levels. According to the latest Bank of America Global Fund Manager Survey, cash holdings have dropped to just 3.5% of assets under management. This is the lowest level since 1998, and it breaks below the 4% threshold that typically triggers a global equity sell signal. This indicates a level of optimism that is hovering near 1987 levels. Mutual fund cash balances are also near historical lows. This leaves hedge funds relying primarily on leverage for their remaining position space. This saturation of institutional buying power explains why market volatility has slowed down significantly into a sideways drift. To track potential market risks effectively, the source document outlines specific volatility and price support thresholds. Monitoring the VIX, a rise to the 18 to 20 range signals increased hedging and downside protection for the S&P. A level above 22 would indicate a high probability of severe downside risk. However, the recent drop back to around 15 shows a current lack of active market protection. For the S&P 500 ETF, the recent 1.37% weekly drop is structurally insignificant, as it missed the 756 mark entirely. True risk only escalates if it breaks below 745, and major risk requires breaking out below 729. The source document next examines Broadcom and its recent financing moves in the debt market for artificial intelligence chips. Broadcom is currently seeking between $70 billion and $80 billion, and potentially up to $100 billion in the debt market for AI chip financing transactions. They are providing their own corporate guarantees for these loans. This financing news caused Broadcom's 5-year credit default swap to spike to a historic high of 113.81. This places it fourth in risk, sitting behind COVID at 798, Oracle at 219, and SpaceX at 172. It remains noticeably higher than Meta at 93, Nvidia at 83, Amazon, Google, and Microsoft. From a balance sheet perspective, this is concerning. Broadcom's total revenue for fiscal year 2025 is $63.8 billion, with expectations to reach $100 billion. Guaranteeing a $100 billion debt load against these revenue figures represents a significant structural risk. The broader supply chain environment dictates that this massive AI infrastructure investment must succeed and generate equivalent revenue. Otherwise, against a backdrop of total U.S. debt exceeding $40 trillion, a failure in AI monetization could trigger financial consequences worse than the 2000 dot-com bubble. Regarding Broadcom's price action, the 324 to 365 range is the current zone for high growth expectations. However, if rising default risk forces a break below 324, the high growth thesis is invalidated. The source document explicitly warns against holding the position blindly if institutions break these critical levels. The analysis then proceeds to technical tracking for Tesla, the IGV software ETF, and NVIDIA. Tesla saw volume push to 362 after holding a recent bottom at 297, which is down from the previous 315 mark. A confirmed breakout above 368 would shift its consolidation range up into the 315 to 465 zone. The IGV software ETF has fully repaired its August 13th daily top divergence through a sideways drop. A small volume increase is currently testing the 107 resistance level, which shifted slightly down from the previous 108 mark.
Broad semiconductors are holding levels around 520, 489, and 532. Meanwhile, NVIDIA is trading strictly sideways between 206 and 216, waiting for upcoming earnings to act as a directional catalyst.
Looking ahead, the source document notes that Q2 earnings successfully validated AI monetization for Amazon, Google, and Microsoft. The next major evaluation milestone for this market will be after Q4 and the midterm elections. During this period, retail consumer spending must be heavily scrutinized. It is a massive GDP driver, and retail sector health is absolutely crucial to balance the heavy weighting of these AI and semiconductor investments. Finally, the source document concludes by observing a technical anomaly on YouTube. A glitch on the platform is currently causing the comment section statistics to display only a few dozen comments, even when hundreds of comments are actually present.